The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for unusual options activity alerts, advanced trading strategies, cutting-edge education, detailed market updates, and breaking customer activity. It's time for the One Option Show to rule them all. It's time for the Option Block with your hosts, Mark Longo from theoptionsinsider.com, Mark Sebastian from OptionPit.com, Mike Tusaw from KnowYourOptionsInc.com, and John Griegas from Options Express.
Welcome back to the Option Block, and it's been another interesting day that we're watching and a lot of stuff going on. But before we even get into that, let's introduce today's celebrity all-star panel. We should do some sort of variation of the Hollywood Squares theme for this part, so we could, I could say, Mike Tusaw the block. That'd be really fun. Starting off on my left with good old Mr. T from Know Your Options Inc. Mike, how are you doing today?
Doing well, and you've inspired me just now. I gotta say it. Circle gets the square.
Oh, you stole my line. Okay, I'll let you have that one. Joining us in the rotating Options Express seat is the prodigal son returning to the show once again, John Griegas. John, how are you doing today?
Doing good, Mark. Thanks for having me back. Mike, good to hear your voice again. What was that Squares game? I think that might be a little too old for me, so I'll go with something out of like Who Wants to Be a Millionaire today.
Is that your final answer?
Yeah.
Hollywood Squares is before your time, eh?
I mean, what year was that? I mean, they had to go off the air in, 88, 84? Oh.
I don't know. It might even still be running. Didn't they have it? Isn't it still running somewhere, somehow? Wasn't Whoopi Goldberg on it for a while or something? If Sebastian was here, this is the kind of nonsense trivia that he would be able to chime in on right away. You know? That and anything McRib related, and we're good.
Oh, yeah. McRibs.
Unfortunately, the greasy meatball is not here. He is off on assignment today, so we will have to make do without his tinny voice chiming in.
The greasy meatball, is that a self-proclaimed nickname, or is that something he got from the show?
That's one of his many nicknames he said he had in college. His nicknames in college rotate. Every show he has a different nickname. But that one has kind of stuck, mostly because I keep bringing it back up. All right, and with that, let's roll right into the trading block.
The Trading Block.
And welcome to the Trading Block. This is the segment of the show where we discuss some of the interesting trends we're seeing in the market right now. And it was a pretty choppy day. The market was down, then it looked like we were going to rally back up, and the markets were unched to a little bit positive. And we ended up closing the day down a little bit. S&P is down about 1.5, Dow down about 20, VIX pretty much unched down the day. What did your commodities do today, Mike and John?
The silver and gold world, we rallied a little bit in the gold, and gold went up a little bit. Silver had a decent-sized rally today, and over at Know Your Options, we actually are a part of silver again. We sold some puts at the 25 level again today, and different people have different things for different accounts for us, so full disclosure on that, but I'd say primarily what we have right now is we're short the January 25 puts right now in SLV, and with that, our plan is to manage the risk to the downside on it. It's not our preferred trade for silver. We prefer to be collared in it, but should we get the pullback that I think we might be getting, no guarantees, but should we get it, then we do intend on getting into a collar type of trade as we pull back. And if we stay the same or go up, at least we're getting some premium. So that's kind of silver right now. And also, I believe, I didn't see it, but I believe we actually touched a 30-year high in silver today. I did not see it, but I believe we actually are coming close to a 30-year high right now for silver. So with that, I'd say that's probably the big story in silver and gold on the day.
So, Mike, are you seeing the silver trend continue, or it did take a pause for about 2 to 3 weeks there? Is it continuing on upward and onward?
Well, what's good right now over the long haul, I think it is. But in the short term, what I was looking at was around the 27.5 level. There was a little bit of resistance about that level, give or take, just depending on if you're looking at silver futures or which contract you're looking at, or SLV, but approximately 27.5 level. When it broke through there, that's kind of what I'm thinking. Well, all right, the bulls are still in charge. So for now, it's one of the ones to where I'm very cautiously optimistic on it, and I feel it's one to where I feel very cautious in selling a 25 put that far out of the money, and that's about as close as I want to get to this one right now. But I do still want to have some positive deltas on it.
Yeah, I was going to say that's kind of not your usual game. Usually you guys like to set up the collars and roll that way. I don't normally hear you guys talking about starting off with the short put side of the equation and then rolling from there.
Yeah, typically not. That's a little bit out of it's more of like a plan B for us, so to speak. We have like a ratio spread hedge a ratio spread back spread hedge, which we can talk about in another show that we'll do sometimes when covered calls go in the money. But for silver, with it going up as much as it has, I believe we're almost up. Gosh, we've almost doubled in a year. I think we were at 14 at one point, or around the 14 or 15 level. So we're almost doubled on the year in silver. That's kind of beyond anything in my toolbox, so we just kind of have to go to plan B on this and continue to stay in it for the long term.
It was an interesting day in a lot of other asset classes as well. VIX once again unched, even though we had a relatively choppy day. I would have thought VIX would have performed a little more strongly to the upside today, but apparently not. And I think a lot of today's action seemed to be driven by Bernanke talking up a storm last night. Any of you guys catch him on 60 Minutes last night?
I did not catch it, but everybody was talking about it this morning. I read most of this transcript, or at least 1 out of 4 pages this morning. I'll have to catch up on that on the way home on the train tonight. But I heard it was very good. They also had, who else was on there besides Bernanke?
I think it was Zuckerberg, the guy from Facebook.
Yeah. I heard it was
talk about a juxtaposition. You got the gray-haired guy from the Fed, very academic, very reserved, buttoned down, and then this kid running Facebook. It's kind of two polar opposites.
Yeah, I did hear Bernanke was shooting around the idea of a QE3. He says that things are a little more dire than people would believe, and that inflation is not at the front of the burner right now. It's the economy getting the jobs back into the market.
Yeah, based on his dire pronouncement, I thought we were going to be down pretty hard today. I mean, he pretty much painted a picture that we're hovering back on the brink of recession again, and that it'd only take a little bit to tip us back into that column again. And maybe the reason we're not down more is because he did say he's ready on the trigger again, and that in case we need another round of infusion. But yeah, he did also say that he's more fixated on unemployment right now. I hear a lot of the hawks talking about inflation or stagflation and these other risks to the economy, but he's definitely focused on unemployment. Can't say I blame him. The thing's been hovering around 10% for far too long for a developed, powerful economy like ours. Also underemployment, which is something that no one really tracks, where people who have jobs, but if you're a PhD flipping burgers at McDonald's, I'd hardly call you gainfully employed. So there's a lot of that out there that is really not measured as well. So there's a lot to be parsed with the unemployment numbers, and Bernanke definitely seems to be taking the lead on that, and that seems to be his key deciding point to whether he pulls the trigger again. What do you guys think? Do you think we need a QE3? Was QE2 insufficient?
Well, the QE2 really didn't seem to do much to the rates. The rates have sold off. Rates have gone up since the QE2 was announced in the amount, I think, of $600 billion plus. You can see that the 10-year March note kind of found support right at 3%. I know yesterday's comments by Bernanke probably put a nice bid in the underlying, but he says we're going to keep these rates low. I'm not sure QE3 can even do it.
Oh, I was just saying, my thought is that I like to think, and I'm going to honor Mark Sebastian here by quoting a line from Caddyshack. And if I ever run for political office, this is going to be my political slogan. And so once you hear it, you're going to see why I will never be elected to a political office. It's right after, during when they're playing golf and they're through 9 holes at the end of it when the judge is taking on Rodney Dangerfield, and he has his spoiled grandkid, and he says, I want a hot dog, I want a cheeseburger, I want a hamburger, and then the judge just looks him in the eye and says, you'll get nothing and like it. You'll get nothing and like it is what I wish our federal government would just say, in that we need to quit counting on the federal government to just print more money constantly. We need to take our medicine at some point. We need to deal with this, and it's just going to be the continuing house of cards. So with that, I say we need to say to America, you'll get nothing and like it.
And I think, looking at at our connection here, I think we have been joined by the McRib himself. Sebastian, you there?
I am. What's going on, guys? Sorry about the delay. Got held up by an airplane.
I thought we had a Sebastian soundboard there. I was like, I like that. That's good. Yes.
Click 1 for MIDI Metals, click 2 for a random 80s reference, and we'll be good to go. Mark, we were just discussing Bernanke's appearance on 60 Minutes last night and talking up the possibility of shooting a lot more money into the economy, the old QE3, and scaring everyone with the fact that we may be hovering on the brink of yet another recession. So did you get watch it?
Mark, I've got this really good analogy about there's a famous scene in Caddyshack where no, I'm kidding. I got the end of that. No, I mean, I agree. I don't think that we need to I don't think we need to be injecting any more money into this economy. Pretty soon we're going to end up, the economy is going to start acting like Bane, and it's going to be uncontrollable and just really messed up. And these guys are getting in way over their head into stuff that, the Federal Reserve was never in charge of doing. So I realize that the Fed's become more and more political, which is kind of sad, but I'd like them to get back to just doing their job.
Well, Mark, one of the things that I heard Congress say is that they wanted to take over the role of the Fed that had the part of creating jobs. And I mean, I don't want Congress, running that. I don't want
anybody running that. Let the economy create jobs. You just keep the money supply at a free and reasonable rate. Keep capital gains low. Keep the bring down the corporate tax, and call it a day. And the economy will take care of itself. People are so tied up in this income tax stuff. I don't think income tax does a lot, to tell you the truth. Now, personally, don't like paying income tax. I don't think anybody does. But where I think you create more opportunity is by lowering CapEx and lowering capital gains and lowering corporate tax. There is trillions of dollars sitting in foreign banks that are not in the U.S. right now because they don't want to pay 35% on it.
They should do that day where they give them all a free tax break and they bring it all over.
Not a free tax break, but
10%.
Lower that rate down. Yeah, lower that rate down to something reasonable, so that these guys can actually pay their, pay the bills.
Hey, work for Ireland, right?
Yeah, I don't know about that, but I think we've got it, and it was interesting watching the Sunday talk shows and listening to these talking heads guys run around the economy and run around the deficit committee. And that's the real issue, is that the last time we had these huge debt and deficit problems, interest rates were really high. Now we've got the same problems, but interest rates are really low. So when interest rates do start to rally, this thing could explode if we're not careful here. So
that's what John was just saying. Part of the intent of the QE2 was to try to ease rates a bit and keep the pressure off those. And, we talked about it about 3 or 4 weeks ago, must have been now, where they had that quick little blip to the downside where Fannie Mae recorded, I believe it was a 4.17 average rate after that show, I went out. A lot of people went out to their various mortgage brokers to try to get those rates, and they were gone before you could even record them, and they were back up to 4 7/8, 5 around there. So it was a very modest, if any, real impact on the rate side. All right, and with that, I think we will bring to a close this segment of the trading block and roll right into the odd block.
The odd block.
And welcome to the Odd Block. This is the segment of the show where we discuss some of the interesting and or unusual activity that we're seeing. First up on the old Odd Block, we're going to return to an old favorite, Dollar General DG. This one closed $30.99, just a hair shy of 31. Closed down $2.44 today, so down about, at one point it was down over 8%. They were supposed to have earnings, I think, on the 9th, but they ended up pushing them up to today, to the 6th. Yep. They came out before the open. This sounded like a relatively upbeat report for the most part, but once again, they did not deliver what the street expected. I want to bring this one up because we have talked about it quite a few times. This was the stock where everyone and their mother was dumping the D's 30 puts for a range between 15 and 45 cents, the bulk of them on the lower side of that range. Right. And so if you hit those puts for 15 cents, and many thousands of people did, you're still looking to cover on these things. And it looks like we saw some put covering today. About 2,500 of the D's 30 puts went up today. In the morning, they were trading 35 cents for a while. The people were scrambling to buy these things back. It looked like the legs had been cut out from underneath Dollar General, and it was trading down close to 30 and a half. Looked like those 30 puts are going to come into play pretty soon. So people were scrambling to buy back those shorts. It looks like they bought back about 2,500 or so today. There was still 13,500 open interest on that strike. So there's still a lot of people out there holding those shorts. The same thing with those D35s. We had talked up that D30-35 strangle out there. And you could have gotten it for around 30 cents if you really worked it. I played around out there after we did those shows. I was playing around in a bunch of different capacities out there, playing with the 30 puts and the 35s and working strangles. And I was amazed that this is the name where the market makers had 16,000 of these at-the-money liquidity dumped on them. You'd think they'd be willing to unload a little bit at relatively decent premium levels, but no dice. You really had to lift offers out here to get anything done. I worked something for a better part of a week, changed sizes, better than mid-market, nothing. It wasn't until on that strangle I finally got filled when I cut the size down to 10. And even then, I had to wait till it was essentially offered at 30 before you can get anything.
Well,
it was
Mark,
amazing.
The first key to execution, and I don't know if we want to get into this, but most electronic eyes are set for 10 or fewer. So what they do is the electronic eye, especially for the medium to smaller range firms, a lot of electronic eyes are set for 10 or fewer. So if you send 10 or 9, I'll do this a lot. I'll send a 9 lot, and it'll get filled 5, 6, 7, 8 times, but a 10 lot can't get filled. I've seen that many, many, many a time.
Yeah, it definitely seems to be the case out here. And maybe, John, you could speak to it, because I think actually for this one, because we were talking about it on this show, I was working it through the Options Express account. Do you see that a lot as well, where people can work, a 5 lot, but a 10 lot you left hanging?
I have seen where, size will scare away the other side. In some instances where we have a big order, we'll sometimes work it like an iceberg, where we'll just show part of our hand, and as they fill, we'll just reload the offer or reload the bid, depending on if we're buying or selling it. But as far as, just for retails, I've never really seen them get hung up as far as, size. But if we're doing something, 100 contracts or more or something like that, sometimes we'll work like an iceberg on the desk and manually work the order.
I like that, calling it an iceberg. That is definitely, especially in the big indexes, that is kind of my MO, is if I'm working anything, I work a nine at a time. And it's actually a really effective way to get, especially in some of these lower liquidity ones, these guys have an electronic eye, and it's probably set to don't trade anything bigger than this, because they don't want to be run over by like like Shein will come in and they'll try and buy 1,000 through the order book cheap, and then they'll cancel that and then walk into the crowd and show their real hand. But they'll try and sweep everything in between before they do that. So you really want to avoid that kind of mess. So
what we do here, we're a little bit handicapped. A lot of what we do at Options Insider, we have multiple accounts, obviously, to kind of sample the retail experience at a variety of different brokerage houses. And I like to try to put in orders on those accounts, that are somewhat approximate of what any average retail guy would do. And a 10 lot seems to be a fair approximation of what most people will do for size. So we try to put those in and see what kind of fills they would get. Obviously, we're a little more nuanced than the average retail guy, so we can kind of work our orders a little bit better. But even in those scenarios, it's still in a liquidity-constrained one like this, even with the liquidity providers choking on at-the-money vol and at-the-money gamma and theta, they weren't willing to unload any of it, which I was kind of surprised at. So, if you're playing around in Dollar General and you did sell those 30s, hopefully you're going to find a way to cover them.
Oh, I think that Dollar General might be, if you look at it, if you pull up a chart at Dollar General, there's nothing stopping this thing from dropping back into 29. The way this thing shot up, what's stopping this thing from getting back down to $29?
I think there is some downside left.
Yeah.
I mean, if you're working on this guy, at this point, if you got that strangle on, or if you short those puts, I would probably look to cover them. If not, work that strangle and see what happens. There actually was even a dime bid I was watching this morning, those 35. So people were scrambling for a while. You could have unloaded it probably scratched it at around 35 or maybe even 40 cents.
Yeah, this thing is choppy, that's for sure.
Probably is not one of your standard safe investment KYO type of names.
No, we do not hold a position in it. So,
of course, obviously, maybe you haven't done your quarterly shopping out at Dollar General, which is probably why the stock is looking so weak. You should have done your shopping before earnings. I told you that about 5 times, Mike.
Yeah, I thought of it, but that's something to look to next month.
You do your shopping on December 7th, and it's too late. The stock's already bottomed out because they missed your quarterly update there.
That must have been it.
Shifting gears here to Clearwire Corp, CLWR. They closed at $6.19, up 16 cents on the day. And this one, if you're not familiar with it, you've probably seen the name Clear at your local mall, and the guys are out there with the little kiosks pushing the cell phones and stuff. And it's actually a subsidiary of Sprint. They handle the 4G network stuff, the WiMAX for Sprint. And these guys have had a lot of interesting developments lately. And Verizon is announcing their own LTE stuff, their competitor to Sprint 4G. So the Clearwire guys have seen a bit of a hit lately. And we saw today that hit has continued. We got a bear came in today and picked up 5,000 of the June 5 puts. So these are out of the money puts for 70 cents. He did it 1 by 2. He sold 10,000 of the June 4 puts for 30 cents. So, this guy, obviously, he could be a shareholder looking for some downside protection, or he could just be a serious bear looking for this stock to hit down about 35% between now and June, down to around the $4 level.
Or, Mark, there could be a third option. He could be a subscriber to 4G and realize it's a piece of crap. Because, I live in a 4G area that Clearwire, will solicit me about every other day. I get something in the mail. My phone is on 4G that's run by Sprint, and I don't get it inside the house. I heard if you have a brick house, that it just does not work.
I looked at the Evo for quite a while before I got the Droid X. Those are kind of the two competing big screen phones. And I was tempted by the lure of the 4G on the Evo, but I've heard, like I said, bad things, that it can't penetrate a wall, or unless you're within 5 feet of a cell tower, you get nothing. But anyway, they also came out and announced recently that they are going to raise over $1 billion in private debt. So investors obviously not liking that as well. So that's part of what's helping to crush this stock.
When I look at this thing, my guess is it's some guy protecting his downside. It could be a guy that's involved in the offering in one way, shape, or form as well, or it could be people playing the offering. So there's a lot of different things that could be going on here. A 1 by 2 would make sense, but I'll bet you the guy is planning on those 4s decaying and selling the 5s for what he's planning on. This thing that he put on for a credit probably turning into a debit so he can unload it. That'd be my bet.
Oh, actually, I should mention, too, in the Clearwire, That's a name that usually does about 1,800 contracts a day. With this 15,000 lot spread that went up, that they pushed over 20,000 contracts today. So obviously a big day and a sizable bear coming out in Clearwire because he took up a good chunk of their open interest with this trade today. Coming up next on the odd block, we have Costco, C-O-S-T. It is the shopping destination of choice for many of our listeners, I'm sure. I keep hearing tales of how great Costco is. I'm not a member yet, but I may be lured to the dark side eventually.
You need to. It's awesome.
That's what everyone keeps telling me. Why don't you go to Costco? It's amazing. I guess if I bought my food in bulk by the pound.
Well, it's not you. You have a need for baby diapers, and that's one area to where the baby diapers alone have saved us a lot of money. So, I mean, just with things like that, we're big Costco fans at the Tucson house.
Everyone told us that, and then when we had the little guy, I just looked around. We went to a Costco, then we went to, like, the average Target. We saw that Target diapers were actually cheaper.
Yeah, no, the cheapest I've been able to find was diapers.com, actually. Where Costco is cheaper than everybody else is actually the wipes, believe it or not.
We have those too.
They own the wipes, trash bags, dog food, things like that. But then there are actually a lot of things there that people don't realize aren't that cheap. They sell a lot of expensive stuff, and it's pretty impressive.
It's the Costco cast. Well, they used to have that cool thing where you could buy something and return it for whatever reason anytime you wanted in the lifetime of that product. So people would go there, before the Super Bowl and load up on flat screens and stuff and then bring them back a week later. So all that gaming, they stopped doing that now. So they've lost that one good value. But, the Costco Bulls are out in force. They sound a lot like you two guys. They're bullish on Costco. Costco closed at around $69 today. They usually average about 6,000 contracts. They did 3 times that today, 18,000. And they have earnings coming up in a couple of days. The D72 halves were just flying off the shelves today. We saw about a block of 3,000 go up really early for 15 cents, right, early in the session. And then 3,000 more went up on the day for a total of over 6,000. 70% of them lifting offers on these things. And previously coming into today, there was an open interest of just about 700 on these. Not exactly an active strike. With earnings coming out in just a few days, these are bulls who think this thing's going to gap up pretty hard. It's got to rally about 5% for these things to pay off. We got earnings on Wednesday morning. I think they're before the open. Yeah, before the open on the 8th. So, a lot of size bulls coming out to play today in Costco ahead of earnings and thinking, like you guys do, obviously, that Costco is the place to be right now.
I don't know about for this short of a term. I mean, like if you on the chart, it's run up quite a bit. We don't have any clients in it right now, just from the standpoint that this thing's run up quite a bit, and not quite the bull on this that we are on other things. And we think Costco is a bit overbought right now.
I agree.
Nice and succinct. We're going to move on to the greasy meatballs, or Mr. McRib's favorite stock. This is Williams Company, WMB. This one closed at $23.93, up about 21 cents. They average about 18,000 contracts in this one a day. Today they put up 120,000. So it was a size day for Williams.
Well, it was a huge call spread that traded. It's actually an interesting trade, Mark. If you look at the open interest, what the guy did was he bought a 25-27 call spread 50,000 times. But then if you look at the open interest on the 27 line, what do you notice? Oh, somebody's open on 50,000 of the 27 calls. The guy made a poor volatility bet. He thought Williams was going to go up. It did. But the problem was he bought kind of the tip top of volatility. He was buying this for Williams around the 16th and 17th of November when the Ivy had topped out at about 38%. So as Williams is rallying and he's making money from the stock going up, what's happening? Volatility was falling on him. And because of that, despite the fact that I think he ended up paying about 34 cents a contract, despite Williams rallying almost 10% from where this guy had bought, which was, middle of November, the calls had not made any money. Time decay, volatility had beaten price. So the guy's sitting there going, wait a minute, I'm right, and I still lost. Again, this is where people usually figure out volatility. The guy was right, and he still lost.
He's just learning on a very large scale.
Yeah. So what did he do? He rolled down to he sold out his 27s for, he lost 8 cents. It's not fun, but 8 cents times 50K is what, $400,000 bucks. He can make that up on this roll down pretty fast. So he rolled down when vols were kind of at the lowest level in Williams they've been for a while. So he rolls down, gets longer delta, gets longer volatility, and hopefully he thinks, Williams keeps going and he makes his money back pretty quick. It's actually a really interesting trade. I liked it. I analyzed this for TheStreet.com and suggested buying the 24 calls for $1.03, with Williams trading about where it closed, $24.90. And throughout the day, volatility did increase in Williams from that point. So it's definitely an interesting play.
We should mention for our listeners who are a little confused that this is Jan, all the stuff went up, and this isn't December. The guy came out and did it, he paid 44 cents for the Jan 27 vertical call spread. Yeah, it definitely was a day. This guy obviously was rolling down. There also was another pretty, not as sizable, but interesting spread going on up in Williams as well. Also leaning on the bullish side of the equation. This guy sold the Dees 23s puts for 24 cents, and he bought 2,500 of the Dees 22 puts for 11 cents. That one obviously is a bullish spread as well. I'm not sure what the news is. I know the CEO is retiring. Maybe that's driving some of this sizable bullish activity. Obviously, a lot of that can be attributed to that spread. But yeah, Williams is not a name that I actively follow or trade. This one you watch a lot, Mark?
Not a ton, but I do notice that you'll see these big prints, and they're right a lot of times. They really are. This is one. What I like about Williams is they're in the oil exploration business, and with the dollar kind of high and oil rallying, if the dollar starts to tank, this thing could do really well. So it's an interesting bet.
It's one of these weird ones that doesn't do much. Does some volume, then bam, they explode on the tape.
Right.
Mm-hmm. Definitely a lot of size institutional players lurking in the wings out there.
That's exactly right.
That's going to do it for today's Odd Block. Keep an eye on Dollar General again, and we'll let you know when Tusaw plans to head out there so we can, you guys can make all your stock purchases. Call purchases, exactly.
Inside info. Come on now.
All right, and with that, we'll close out the Odd Block and roll right into the Express/Spread Block.
The Spread Block, brought to you by Options Express. Options Express lets you trade futures and now foreign futures too, where and when you want. From advanced charting and free daily trading ideas to automated systems trading and free educational resources, Options Express is the online broker for all traders. Visit optionsexpress.com to open your free account. Futures involve substantial risk and are not appropriate for all investors. Please read this disclosure statement for futures and options available at optionsexpress.com/futures risk or by calling 1-888-280-8020 prior to applying for an account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome to the Express/Spread Block. This is the part of the show where we all sit back and listen to John Grigas' sultry tones. Maybe you put on some Barry White in the background and uncork the wine, and you just sit back and let his tones wash over you. John, what's going on today in Options Express land?
Well, a couple of months back, I had a customer bring to the attention that the SPX, and Mark, I think were you an index trader down at the CBOE on the SPX or OEX?
I was.
Yes, I was. Yes.
Okay. Yeah. Well, the SPX executed FIFO, first in, first out. I guess about 2 months ago, I was just trying to read some of the memos that they had. They switched to a pro rata execution format. And if you're not familiar with that, if you were the best offer and you were first in line and 10 contracts traded and you were working, 20, well, you got all 10. Now with the SIBO and the pro rata ruling, they now will disseminate that among the, who's in the queue with the largest size. So if you jump on the
really?
Yeah, so that, this is kind of a big thing for retail. When I traded futures myself on the 10-year, 5-year, and 30-year interest rate futures, and they went pro rata in the 5-year note, it killed me. I had to trade a different product. I couldn't trade it anymore. It was unbelievable. You didn't know what was real, and you knew that the people that with the size were going to get a larger portion of the edge, and you were going to get bypassed. I had this client who, he just trades premium on the SPX, and he was getting partial to death, and he really couldn't continue with his strategy. We had talked to the SIBO, and they had said something that they had changed to a pro rata because they had issues with VIX settlement. So, Mark, I thought, being an SPX trader or from the floor of the SIBO, what you think their real intentions were to change it from a FIFO to a pro rata?
This has to be a play in anticipation of the electronic VIX coming out down the road. I mean, this move in and of itself is going to scare off any retail business they have left in SPX. They must know that. And they've already been hurt pretty badly by retail business flying off to the spiders, which is the reason they're planning to launch this electronic SPX contract, or say they're planning to launch. I'm still kind of dubious on it, but they know by making this move, it's obviously making SPX more solidified as what it is, which is an institutional pit, an institutional product, and they will maybe force their retail to the electronic version, which maybe the electronic SPX will be able to maintain the FIFO system instead.
Mark, that's a great point, and Sebastian, go ahead. But to just add to that, the C2, the all-electronic SIBO exchange, is going to stay FIFO. So I'm not sure if they're just trying to say, hey, retail, get out of our way, go over here. So at least they're giving them a branch, an olive branch in which to still trade in that method. But I don't think they're even up.
Yeah, but that's going to be even worse for retail people because
the spreads.
Spreads and payment. The issue here with C2, this makes total sense. Now I get it. This is a total sellout to the. This is totally for the liquidity providers. That's who this is for. Basically, what the SIBO is doing is, the fees were getting so high on the SPX. You know what the fee is for somebody to trade on the SPX?
88 cents.
It's 40. I think it's 44 cents a contract, not including all the other stuff. The SIBO itself charges 44 cents a contract. Well, one of the problems they're having is that the liquidity providers don't like SPX and would not promote SPX in the retail environment because they don't want to pay that big nut. And the SIBO's been sitting, kind of worrying about this ES, whether ES options themselves would maybe heat up or something like that. So how do you solve the problem? Well, I've got a good idea. What if we could take a customer order that you're paying 44 cents and cut 20 cents of the price off for the liquidity provider? Oh, yeah, or even make it free for the liquidity provider to route the order. Oh, we'll put it on the maker-taker model. So the SIBO's taking no risk and still getting all this retail money, and they're getting the big money from the institutional and the pit. I don't really.
Yeah, it was frustrating for the retail people, I believe. I mean, we'll see what comes of it. Another kind of thing out there that's really bad for retail traders. And that's what happens when you have one exchange that owns one, contract. They just manipulate it in the way that they see fit.
Mm-hmm. I know. Well, it's a bigger problem than that because it's all the exchanges manipulating all the orders, and then, the real dirty players in this business, in my opinion, are the liquidity providers, not Options Express, not. And the exchanges are, they're basically kind of forced into this, but it's the liquidity providers that basically are for sale to the highest bidder. Who cares about the customer? That's the real issue. And they're pervasive. These type of liquidity providers are pervasive among the discount brokers, which sadly too many people are heading toward. When I mean liquidity provider, I mean somebody like that takes order flow. I should say order flow provider.
Order flow provider. Okay.
Yeah.
I was a little confused by where you were going with
I don't
that. Okay.
mean liquidity providers. No, I'm sorry. I feel for the liquidity. It's the order flow providers that are kind of the ones with their hand out in every single way they can go.
Yeah, I completely agree with that. Yeah. Damn you, John Grigas.
Yeah, and they're holding retail paper hostage because they want to get paid on both ends. It's really, really kind of sad. Well, I had a conversation with a trader, claims to be a customer. He trades probably 50, 60,000 contracts a day in Citigroup. Makes no money, zero, on the actual spread between the different options. Only collects payment. That is how he makes his money. And there's a lot of that. One of the things that's really one of the things that really that they really missed the boat on that 60 Minutes interview was the fact that a lot of these flash trading and black box trading, they're all going after payment. And we should make sure that people understand what an order flow provider is, because it's not Options Express or some of the other ones. Options Express manages their own paper for the most part. A lot of these retail discount brokers take your paper and then sell it to a liquidity provider, or an order flow provider, who then takes that order and uses it to collect payment. And that is what is going on with a lot of these maker-taker / other exchanges. Does that make shine a little more light there?
What do you say to all this, John?
I'd say, what was my second point about the SPX? No, I mean, we have direct routes to the exchanges, so we fire in at the MBBO, we guarantee the MBBO. So, if we don't get you the MBBO price, we guarantee it. So, I mean, we don't. I know TD Ameritrade. I read an article in one of the magazines a few months ago, and he was talking about how he's got a proprietary system that routes it to the best exchange. Well, if you actually, think about the article and actually read in between the lines, he's sending his order flow where he gets the highest payment for order flow. He's not doing it. That's
exactly right.
He's not doing it to get the best execution. He's looking out for his own skin and trying to get, and he's selling it, like Sebastian said. Here we route our orders right to the exchange to guarantee best MBBO fill prices.
Right, and that's exactly what I've been meaning to say is that we've talked about this in detail, but the rise of these maker-taker exchanges, the C2s of the world, the ISC2 or whatever you want to call it, has made this order flow game. It's brought it to a new level because now they're gaming order flow providers that aren't like Options Express, who, as I've said on many occasions, is renowned for their execution.
Yeah, and in the long run, payment for order flow is going away. Eventually.
Yeah, you'd hope. You really would.
That's the SEC's stance. They've been trying to do that for the last 10 years by doing nothing and then forcing pennies down our throats and thinking that's going to solve everyone's problems. Because squeezing the liquidity providers, that's the way to make payment go away. Because they're the ones insisting on paying 40 cents a contract. They're the problem.
Yeah, exactly.
One other thing I did want to mention about the SPX, since this just happened last Wednesday, the SPX has changed their weekly options from a Friday morning settlement to a weekend PM settlement. What that means, the standard third Friday, or I should say the Thursday before the third Friday of each month for SPX, it still remains the same. Your last trading day is a Thursday prior to the third Friday, and then your settlement's based off the opening, special opening quotation as they refer to it. But now the weeklies have changed, so your last trading day is going to be Friday, and it's going to be a PM settlement. So I just wanted to get that out there. We have customer service alerts for people that are trading SPX, and we've emailed customers too, but we don't want them to be shocked when they see that they're still having price fluctuations come Friday afternoon on their weeklies.
Yeah, when will the closing print? When would the closing print be? Is it at 3:15? Is it like basically you're trading the closing print on that Friday?
If you got the two memos that the SIBO sent out and laid them side by side, they completely contradict each other. But we've had conversations with their help desk. They do trade until 15 past the hour, 4:15 Eastern. But the settlement's based on the closing prices of the stocks that make up the index. So it really can't be based off a 4:15 Eastern settlement. It has to be when the stocks close. It's still going to be a special quotation, closing quotation for that index, but they do trade till 15 past the hour, and I believe that's how the OEX settles.
There's going to be so much gain.
Yeah, if you have concerns, get out.
Oh, that is awesome. I would love to trade those. There's going to be so many people buying those because they see the futures rallying.
No, I know. I think it's going to be, for our retail clients, just, I'd say don't trade them after the top of the hour.
What do you mean? I'm long that strike. Print those up about 2 handles right there. Yeah, those are down short those. Those print down about 2 handles. Okay, good. There we go. That's our settlement right there. Yeah, anytime there's a settlement involved in the SPX, you have to kind of cross your fingers and hope for the best. Speaking of settlement issues, I think it was Tim or Rob, I forgot who brought up on one of our last shows that there were some customers having some questions about SPY. Was it SPY or SPX settlement they were having issues with? What was the resolution of that for you guys over there?
It was the SPY settlement. Yeah, it was based off of Bats put out they put their after hours trades on that abbreviated session the day after Thanksgiving, and they were printing stuff an hour and a half after the primary close. And since they were the last trades, they used their last trades off the extended hours as the primary settlement of 1880. OCC says that once they submit a price and they use 1880, they can't go back and readjust. So they used a wrong price and they made a mistake.
Okay, so that explains it. So you guys aren't left holding the bag then for some crazy print or anything like that?
No, it's pretty much said and done. It's unfortunate that it happened. I mean, it's another, electronic snafu that, hurts the credibility of the electronic age and, of these exchanges.
All right, John, that was a pretty informative express/spread block, and our listeners should stay tuned. So we're going to close out the express/spread block, and we're going to kick it right over to the disembodied, ghostly voice of Rob Kurzakowski, where he will fill you in even more detail on the contract adjustments for the special OX dividend that just was announced last week. I know we had a lot of questions about that, and why aren't those DS15 puts a screaming buy at a nickel with a $4.50 dividend? Well, he will explain why in more detail coming up right now in the strategy block.
The strategy block.
Well, I know the big news coming out of Option Express, obviously, aside from the love from Kramer, has been the announcement of your special dividend. That's been lighting up my tape today on the Options Insider. Our forums and our email accounts have been lighting up for the last couple of days since you announced it with questions about that. In fact, and this actually almost is also a strategy block as well. So we got a lot of questions about what's going on out there with the stock in relation to the dividend. In fact, I noticed before we started recording, we actually had some posts on this in our forum as well, including one of our members who goes by the name Complete Beginner. He posted this. He wrote, Options Express special dividend. What am I missing? He said, Options Express just announced a special $4.50 dividend payable before December expiration. The stock is currently trading around $18.50. The DS15 puts are offered at 15 cents. Am I missing something? Why aren't these puts a screaming buy? So let's get into that a little bit then. The concept of dividends hitting the stock and these special adjustments that we're seeing, the contract adjustments. I'm sure you're getting these questions from your customers as well, because I'm sure a lot of them are active in the stock. Well, let's talk a little bit about what's going on with the stock and why these puts are not a screaming buy at 15 cents.
Well, the Option Clearing Corporation, when you have a special dividend or even a normal dividend, the option value or the option contract gets adjusted to reflect the terms of that type of that corporate action. In this case, the stock the stock price on ex-dividend date, all things remaining constant, will drop by $4.50. the contracts accordingly will drop by. The strike prices will be adjusted down by $4.50. We get these questions a lot, especially with all of the ETFs and the reverse splits and the positive splits that we've had, and like FAS and FAZ. Recently, the AIG reverse split. The client will have $1 call and wonder, the stocks now jumped. With the case of AIG, the stock jumped up to to the teens. Why is the option not trading at this high value? And that's because the Option Clearing Corporation isn't going to let traders either be either capitalized or be punished by corporate action. Obviously, new shares or new options listed after the corporate action will trade normally 15. Put is going to have a much higher value than a newly issued 15 put is going to have a much higher value than one that's already been listed and been trading. And that's one great thing on our website is we do from our standard option chain after there's some sort of corporate action or where we have an adjustment to an option. Unless you actually check off the box and you're actively looking for that, and you're looking to get into a trade, those options don't show up. Likewise, when you're on the order form where clients will choose a strike price, the adjusted options will be denoted by an asterisk. That way, we'd rather have you wonder why does this option have an asterisk and give us a call than to get yourself in an option that you really didn't understand going into it. So we get quite a few questions. The actual ex-dividend date and the record date are not what you typically see with a standard dividend as well. The record date is actually the 13th of December, and with the special dividend, the record date, it just establishes the actual shares outstanding on the date that are eligible for the dividend. The dividend, the ex-dividend date itself is actually after the payable date, and that's going back to an NYSE rule. And we had to actually look at break out take the dust off the old NYSE rule book.
Yeah, that seemed to me too when I first saw that. Yeah.
But when a distribution is 25% or more of the stock's value, the exchange will defer trading the security X until one day after the mail date for the distribution. They don't want companies announcing this big special dividend and then never mailing out the check. I assume that's back when the firms would actually mail out a check instead of just transfer the cash into the various clearinghouses.
Yeah.
So it's a very different. A lot of people are expecting the stock to actually go X back on December 8th. This is the T plus 3 between the ex-dividend date and the record date that you see in a normal dividend. This is actually a very different situation, so you don't run into these very often, and we encourage our clients not only with our special dividend, but anytime you hear about a special dividend, give us a call. We can give you a full breakdown, and you'll see why the dividend yield on the quote detail page is showing this astronomically large figure.
Well, yeah, that would explain, too, for a lot of our listeners, why these DS15 puts are not a screaming buy, even at a nickel. These are actually the 10-half puts once you adjust for the dividend, and I don't think you want to run out and buy the 10-half puts right now, unless you're really bearish on Options Express for the next few weeks. I know, for myself, I've always used 10% as kind of that guiding point, rule of thumb, demarcation where the OCC would step in and adjust the contracts. Do you know, is that a hard and fast rule beyond 10%, the dividend, that they're going to adjust it, or is it kind of a play it by ear type of thing?
Actually, since since earlier this year when we had the change in symbology, the OCC has been a lot more consistent about adjusting strike prices. I believe that it's all 10% dividends will automatically get the strike prices adjusted. All standard stock stock dividends, where you see a normal ratio where you don't have odd increments or odd deliverables, will get adjusted. The only case that you don't see any adjustment is the reverse dividend, because you can't have fractional options. So the OCC has been much more consistent with how they have adjusted options since. When did we have symbology? That was back in February.
Yeah, it was earlier this year, yeah. Well, it's good to know that they're getting more consistent on that. I know in the past it was kind of a fast and loose type of thing. If it was way more than 10%, it would get it. If it was around 10%, it would kind of be a hemming and hawing type of decision. So it's good to know that they're being consistent on applying that across the board going forward. So our listeners can know that if they see a special dividend coming out that is greater than 10% of the value of the stock right now, you're going to see a contract adjustment. So just prepare for that. And that's going to do it for the strategy block. And now we'll roll right into Around the Block.
Around the Block.
And welcome to Around the Block. This is the segment of the show where we discuss what's on the horizon for the next couple of sessions. And there's a lot of interesting stuff coming out. Obviously, we already had the employment stuff last week. Bernanke seems to have refocused the laser on employment by saying that's kind of his key trigger now for whether or not he's considering a QE3. And on that front, we have initial jobless claims coming up on the 9th. That's probably be one of what the market is hovering around next. See how those look. We'll kind of roll from there. So what are you guys looking at?
You know, as I said last week, I'm looking at volatility. I'm looking at, just that's about it. Maybe the tax stuff, it sounds like there's a deal done there. So with volatility this low, I'm looking to see whether this is saying, hey, we're going up to 1250. Can we break through the highs that we got earlier in the month? You know, in November, we got up on the 5th to about 1227. Can we break through those? Can we break through 1227? We've not. If we broke through 1230, I'm not a technician on any level, but look out. I think we run to 1250, maybe higher. The other thing is, volatility is at very, very, very low levels right now. Looking at the SPX volatility over the last year, we are definitely at the lowest level since the flash crash and sitting on levels that we really only saw in April and March of last year. So I'll be real interested to see where volatility heads.
Yeah, I'm just looking as we're talking. I'm looking through the VIX skew and looking at some of the upside here in Jan and Feb and seeing if I see any good screaming places to dive in here. I'm not seeing any especially good entry points right here yet. I'm hovering because I definitely lean on the upside of the VIX equation these days.
Yeah, well, you got to remember right now the VIX futures are trading over $19.
Yeah.
The VIX GD's futures. So an interesting spread is you could do the 18, 21, 22. This is another one I suggested for TheStreet.com. We bought the 18, 21, 22 bullish broken wing butterfly for 75 cents. I think it's at a touch of a loss right now, but not very much, and I like the way the spread looks. So right now the VIX futures are trading around 18 what is that? 1860.
Yeah, it's one of the ones we always have to remind our retail listeners on. Is like, why are these not pricing off the VIX cash?
Exactly.
It's a long I should just record that conversation and just replay it over and over again.
Mm-hmm.
It's kind of an interesting one. What about you, Mike? What are you watching? Obviously, you're playing a lot in the silver and gold these days. What else is kind of on the horizon for you guys?
Well, we're looking at, we have just kind of like what Mark said, from a technical level, if we can break through this, the bulls could be in charge for quite a long distance. But I think this is also a pretty pivotal time in that we need to break through the levels which we are right now on the S&P 500. In terms of stocks with which we're looking at, we are looking at Cisco right now, and it's one where we want to see it go through the 20 level before we give it a second look, so to speak. So we're looking at that, and we're still just continuing to do what we do in that we're hedging things, collaring them, and doing covered calls, and being long-term bullish and short-term cautious.
So you're going to join the ranks of the Cisco bulls that have been scooping up Cisco down to these levels?
Not yet. I want to see it go through 20 first before I join those ranks. But if we can get above 20, then it's kind of like in the NFL, you have the first cut and the second cut. It has to go through 20 so it can make it past the first cut, so to speak.
So Cisco, closed today at 1943. So it's up a little bit since we started talking about it a couple of weeks ago. I think it got down to the 18 range. You're going to scoop up the underlying? You're going to start loading up on short puts? What are you going to do out there?
With Cisco, we're thinking short puts right now. Nothing, like I said, nothing set in stone, but initially kind of what we were thinking are short puts. But keep in mind, if it goes above 20, that might drop some volatility on it, so we might not be able to go that route at the time. So
yeah, waiting for a rally might be a hard time to hit the short puts.
Yeah, so there's a couple of things that we're looking at, either a short put or a collar, something along those lines, but usually either involving the underlying or a non-levered or a cash-secured put.
Nice thing about Cisco is that it has weeklies as well, so if you want to go the short route, you can hit them on a much more active pace and squeeze out a lot more theta for your buck. Do you guys work the weeklies a lot, or do you guys kind of just roll maybe a couple months out in the puts and go from there?
Occasionally a weekly, but for the most part, it's not primarily what we do. So yeah, I'd say primarily we're a little bit more, usually 1 to 3 months, I would say, most of the time, and in terms of the option selling side of it.
You know, I hear that a lot from financial advisors, that a lot of times it's just a time thing, and they don't want to be rolling options every week or a few weeks. They want to have even though it might be better bang for their buck for them in the long term, it's hard for them to do across all their clients to manage all those positions at once, so they tend to lean a little bit longer term than maybe they should, just because it's easier for them to do.
Well, it's one I have no problem with the weeklies. I stare at a screen all day. It's just that it's not so much the time issue. Brokers Express has a great group trade platform to where it's not an issue at all with that. It's more of a gamma issue, in that with what we're trying to do, a lot of the times it's just too much of the big move. If we do have a big move, or can compromise the overall integrity of the position too much. And if we're short calls every week and the markets get too choppy, then that's a risk that it doesn't match the profile of our clients a lot of the times.
Yeah, that's true. You can get some nice swings and whipsaws in the weeklies. And we heard from the Options Express guys, they get calls every week of people getting whipped out on these weeklies because they kind of swung for the fences. It's a very tempting thing to do with those little contracts, I can imagine. So I think that's going to do it for this episode of the Option Block. I want to thank you guys for joining us. Mr. Sebastian, late is better than never.
Thank you.
Mr. McRib, what do you have on the horizon? Any good webinars coming up over at Option?
I'm doing, I wrote a feature article for Stocks, Futures, and Options magazine this month, titled Know Your Alternate Routes, Part 2 of a series. I would suggest everybody read it. Check out my blog, optionpit.com. /blog. I write every day. There's usually something interesting. And aside from that, that is kind of all I'm up to for the rest of for the next couple of weeks.
You guys have that cool issue you just put out too of Expiring Monthly with the futures option stuff out there.
Yeah,
that's pretty interesting. So that's worth our listeners, if they haven't checked it out and they're interested in maybe diving into the dark side of futures options versus ETF options, to give that one a look-see.
Oh, yeah, for sure. We came out with our futures options magazine for Expiring Monthly, and I'll tell you, the CME was in love with it. They thought it was really well done. It is, in my opinion, the best one we've done yet. Next month, we're getting into kind of, we're going to talk about where the option markets are going. Then we've got just a whole, we're going to be doing year in review looking forward in January before we get into non-directional spreads in February. So we've got a lot of things on the option on the block at expiring monthly. So
no pun intended, I'm sure.
No pun intended.
And then, of course, the Options Express boys can be found over at optionsexpress.com. Just call and ask for John, and he'll take care of all your problems personally. Just tell him I sent you, and you should be all set. And then, of course, Mr. T over at knowyouroptionsinc.com. You guys have any other interesting webinars coming up or any other interesting events?
Yeah, we got this coming weekend on December 12th, we're going to be doing a Sunday night, our weekly webinar, in our weekly webinar series, The Condor Flies Again. It's going to be about a half-hour webinar on the Condor. We'll be discussing just the strategy itself, and we'll be going over the arrogant Condor trader, as I like to put it. Someone who makes money 8 times in a row and thinks the Condor is an annuity. And then on Monday night we have a webinar. It's all Greek to me. We'll be going over just an introductory level class on option Greeks, Delta, Gamma, Theta, Vega, and of course the wicked stepchild Rho.
Bro. There you go. That'll get you some downloads right there.
Rho, you know what? You say that Rho is a very important Greek. Especially with those people that trade leaps and don't know Rho are doing themselves a very, very major disservice.
That is true. If you're trading the long-term stuff, you definitely need to be at least cognizant of the impact of interest rates on your positions.
Now, do you guys think it's an issue like for the short term, like for the 1 to 3 month people?
Maybe if Bernanke starts going crazy.
Yeah, because right now, I would think for right now, it's not much of an issue at all in the short term. But I can definitely see it for the leaps, just because of the fact that if the option's not if you're not earning interest on your money, it's not right. I get that.
Yeah, unless they start jacking up rates, it's not going to be a huge deal in the short-term trades. But anybody who's buying, back month trades or back month options. Needs to understand the row component. Very
I know
important.
a great place they can learn about it on Monday night.
Oh, really? I'm not. Oh, that's right. Know Your Options Inc. Great company. That's a good place to learn.
And of course, for all of the unusual activity and news and other events that we discussed on the show today, surf on over to theoptionsinsider.com. If you aren't there already and streaming this show off of our website. Of course, we want to thank all of you for listening and for streaming and downloading and subscribing to this show. You make it all worthwhile. All the pain, all the listening to Sebastian a couple times a week. It's all worthwhile because of you.
And you know what? If you like the show, tell some people about it.
Yeah, there you go.
We're not asking you for money. We're not asking you for much. All we're asking you to do is tell others how great how great this show is and how much you like it. Unless you hate it, then don't tell anybody.
Yeah, then just keep it to yourself. That'll be your gift to us for the holidays. You're like, I can't take any more of that Tusa, god damn it. No more. All right, and with that long-winded outro, we will close up this episode of The Option Block, and we will see you next time.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved.